Hello and good morning, folks. Welcome back to Almus Market Mornings, your daily dose of financial updates. I'm back from my slumber, your host Shikhar Garg, to begin the new financial year with some regular financial updates, even though the year can be some bit exciting. The FI seems to be coming up with some temporary relief as the oil retreats, probably on the news of China increasing lockdowns, as well as the announcement of SPR release. Now, the other current commodities have also corrected as we see the central banks continue to struggle to hit the right space as we see the neutral rates are still not in sight. Now, JK, what do you think? What should we be looking out for with all these rate curve, yield curve inversions and oil prices, inflations on the fore? Please tell us.
Hello, good morning. First of all, wish you all a very profitable new financial year. We ended last quarter of FY22 with risk assets losing in the major markets under the environment of high inflation and expectations for steep hike in policy rates, particularly by the Fed. As we enter the new quarter, sentiment remains neutral to negative as there is no end in sight of the Ukraine war and the economic war continues unabated. Yields continue to rise, and in US, in fact, we have a clear inversion of the yield curve between 2 and 10 year. While the popular belief going by history is that this indicates a recession in medium term, we also have special factors affecting the same. US QE was still in place till March, which would have avoided the long-term yields going too high, while at the same time, the unlimited bond buying intervention by Bank of Japan is leading to fresh printing of yen, which in turn finds its way to US long bond buying. On the crude prices, however, it has reacted lower, reacting to US decision to release 1 million barrel of oil per day for the next 6 months from their strategic reserves. In the light of this decision, market ignored OPEC decision to continue their earlier conclusion of increasing output by not more than 400,000 barrels per day from this month. Decision of International Energy Agency's 31 member countries agreeing to release more oil from their emergency reserves also helped bring down the prices. Technically, we are looking at the oil testing the 95 level once again, but that should broadly hold until the Russian supply situation is resolved. On the dollar, euro and yen remain focused, the former due to the changing expectations on rate front, while the latter finds sellers due to widening differentials with US. Commodity currencies remain well supported due to high prices of metals and soft commodities. We are looking to see the European final response to Russia's insistence that they be paid in rubles for oil and gas imports, otherwise threaten to cut the supplies. India's current account deficit surged to a 9-year high of 23 billion in the third quarter of financial year 21-22 from 9.9 billion in July-September 21 due to high merchandise imports, and as a percentage of GDP, current account deficit was at 2.7%, compared with 1.3% in the preceding 3 months. The sequential widening of the deficit was on account of the big spike in merchandise trade deficit to 60.4 billion in Q3 from 44.4 billion in Q2. Forecast for full year CAD is at over 40 billion or 1.5% of GDP. But of greater concern for me is the deficit for FY23, which would hit over 2.5% of GDP if global crude prices remain elevated. The initial measure of, or rather estimate of merchandise deficit for March is expected at 18.69 billion. Although less than last month, it's still higher by historical levels and may see the full year deficit at 193 billion as against 152 billion pre-pandemic. RBI also announced their borrowing program for FY23 with the first half being front-loaded as they plan to borrow as much as 8.4 lakh crores. Without heavy lifting by RBI through their open market operations, the response to the new issues from the market would not be great, and investors would demand higher yields for any participation. With global inflation and yields already higher and domestic inflation expected to be higher than 6% again with fuel price hikes, expect yields to inch up towards 7% or beyond in the coming months. Rupee, of course, has challenges from the fundamental side with higher deficits and global commodity price rises. But near-term outlook remains rangy between 75.50 and 76.30, with RBI being active container of volatility. While FIs have already sold heavily in the last financial year, we're still not sure if they would resume buying in the Indian market as the funding costs remain elevated across. That's it from me for today. Thank you and have a nice day.
Okay, great, JK. That was truly enriching. So the sentiments are still neutral to negative as we hear, and though the yield curve control continues for the benchmark yields in Japan, they were still kept around 0.25 as against the 0%. Now, do we see the yield curve control coming near to a halt, or what exactly is going on is to be watched out for? And yes, the Eurozone's response on energy trade in rubles can be a key thing to watch out for again. Another good highlight that I would want to reiterate is the higher yields for Indian benchmark. Now, this can sway some bit of interest eventually in the capital allocation which goes on. So guys, interesting year ahead. We hope that you have a good profitable year. That's it for today. Thank you so much.